Hello, everybody. Welcome back to Adair Live. We'll be hosting these every week, featuring experts from the home building industry to help you understand the ins and outs of building your new dream home. So again, my name is Jay Sowers. I am the Director of Sales here at Adair Homes. And today I have with me Ryan Holtkamp. So Ryan, do you mind introducing yourself and kind of telling us what your role is at Adair Financial?
You bet, Jay. Thanks so much and welcome everybody. My name is Ryan Holtkamp. I am the General Manager at Adair Financial Services. Adair Financial Services has been around since the early 2000s, about 2003. We fully support Adair Homes and all construction mortgage related endeavors. I have been with the company now a little over 7 years. I act as the General Manager here over a group of originators and processors.
Beautiful. Well, thank you very much for that, Ryan. I know we sure appreciate all your efforts. So team, today we're going to be talking about navigating the current lending climate with kind of new loan options from Adair Financial Services. Please understand that we will be monitoring the chat. So let us know where you're watching from. Tell us where you're thinking about building. Tell us what part of the home building process you're in, whatever stage that might be. We would love to hear from you. So again, hit us up in the chat. We'd also love to address any questions that you have about financing, any kind of financings. This cast is specifically new construction financing. So put those in the questions. And with all that said, let's get rolling. So Ryan, I'd love to kind of ask a first question as any attendees are putting questions in the chat. But can you give us some background on Adair Financial Services and how long has the company been serving Adair clients?
Yeah. Thanks, Jay. Yeah, so we started 2003, and all as we do is support Adair Homes. Anything Adair related, we support. Definitely over that time frame, there have been peaks and valleys, as you all know, in the mortgage industry and real estate industry. But what's been really successful for us is we're just backed by a very, very good builder with Adair Homes, and supporting them has really been our pleasure. And then providing a good customer experience has been paramount to us, and that's what's kept us going for so many years.
Awesome. So Ryan, if you don't mind, can you kind of articulate, not specific to Adair Homes or what you and I experience, but just kind of out there in the industry today, what is the current lending climate, and what impact do you believe that it's had on people shopping for homes?
Yeah, great question, Jay. I think you could ask that question to 20 different experts and you may get 20 different answers, but I'm going to do my absolute best. It is the word I would use right now is just challenging. I've been in the mortgage industry since 2003, 2004, and been through many peaks and valleys. And I know what comes up will always come back down. But we're in this weird time in the mortgage industry where it's almost like we've woke up one morning and rates have doubled. And the reason really behind that is twofold. One is the Fed artificially was buying mortgage-backed securities through March. And that was doing, it was allowing banks to sell those mortgage-backed securities and provide them more liquidity to lend more money to consumers. Well, what that caused was demand. What happens when demand goes high is it increases inflation, right? What is inflation? It's really just the rate of increase of costs over a given period of time. So coupling that all together has just pushed up mortgage rates over the last year or so. It's become a bit challenging, but what we're starting to see is it has settled down a little bit. And when I mean settled down, I don't mean rates have been decreasing. It's just the liquidity has come back somewhat to some of these banks and lenders. It was interesting, Jay. I was looking at a graph over the last back to 1975 and looking at interest rates, and you can look at, and it's just peaks and valleys. Obviously in the 80s, rates were over 15%. But if you look at the median from 1975 to today, it's 5.75%. And that's kind of where we're at right now in the mortgage industry, is right in that range. So we're not higher, we're not lower, we're really right at the average over the last 50 years. So, it has become a little more painful for customers now, because with increased interest rates means higher mortgage payments, which affects affordability. But in the long run, as I said, this will start to come back down. Now, the bigger question, Jay, is when. That's not a question I can answer right now, but I'll tell you this, that from my experience in being in the industry 20 years, it will come back down. It's just where we're at right now. We're kind of in, at a peak.
Interesting. Yeah, and it kind of sounds like mortgage rates are just getting back to what they historically have been, right? Some of that.
Right.
So another question I know a lot of consumers have is, Ryan, can you help everyone here understand what is the difference between like a mortgage?
Yep.
So I'm going to go look at buying an existing home, and a construction loan.
Sure. Absolutely, Jay. Yeah, you mentioned the word existing. So the big difference between a traditional mortgage that you're going to do a refi or a purchase on, the structure's there, right? It may be new construction, it may be existing, but the structure is there. So you're qualifying with the loan, pay stubs, W-2s, all the standard qualifications, standard appraisal, but the structure is already there and you're closing in about 30 days. Construction loans are somewhat different, where there is no structure initially. You're putting together plans and specs, all of your costs together, and we're lending money on the proposed build and where that's going to end up at. So what happens, Jay, is you fund your construction loan before any work is done, any construction, and then from there it works like a credit card, right? As you pull funds out, your balance goes up, and you're making interest-only payments on that outstanding balance, right? Now, when the home gets completed, we will then do a simple modification, and that's just paperwork shuffle. It's signatures, and that modifies that, what we call temporary loan, into your permanent loan. So it's basically taking that line of credit, almost paying it off, and transferring it into your permanent loan, which is your mortgage, your interest, your taxes, your principal, your insurance. That's your total payment together. So really the big difference, Jay, is one, we're lending on a structure and it closes rather quick. The other one is we're lending up front, and then we're modifying the loan into your permanent loan when the home is done.
Got it. That makes sense. I know just a lot of consumers that we work with kind of have that discrepancy on what's the difference.
Yep.
So, Ryan, for any of us looking to get pre-approved for a loan, can you kind of talk us through what are the steps to get qualified?
Sure.
And how to determine what maybe my loan amount would be.
Yeah. So as far as qualification goes, everybody, there's really no difference in qualifying for a mortgage if it's existing or construction. We're looking at your income, we're looking at your credit, we're looking at your assets, we're looking at proposed value. So all those things are relatively the same when you're qualifying for a mortgage. For us, we have a way of, we can apply online, you can apply a paper application, and we don't initially run any hard inquiry credits, so it doesn't affect your credit score. So it becomes pretty easy to get qualified with us, and that really establishes your budget. That's the first thing we want to look at, is what is your budget? So how do we understand what the loan amount will be, or as a consumer, what can you do to kind of look ahead to see what I could potentially qualify for? And that's really pretty easy. So what we're going to do is we're going to look at your debts on your credit report, what's reporting, the monthly amount. We're going to add that up. And then we're going to take your proposed mortgage payment. And then we're going to add all of that together. Let's say your monthly debt on your credit report is $500. Let's say the payment's $2,000. That's $2,500. So if you make $5,000 a month, we're going to divide that in to give a percentage, what's called debt to income. So in that case, $2,500 into that $5,000 is 50%. What we try to do is keep the debt ratios at below 50%. So when you're all looking at qualifying for a mortgage, it's just simple. Add up anything on your credit report, a proposed mortgage payment, divide it into your gross income. And if you're married and you both have incomes, you add that gross together, and then you divide your liabilities into it, giving you your debt to income ratio. And that's how loan amounts are really set, Jay.
Interesting.
Yeah.
Okay. I know a lot of our consumers have always asked, like, well, how did you come up with this number that I'm personally able to qualify for? So thank you for explaining that.
Yeah, you got it.
Another question, Ryan, is this is going to be, again, let's circle back to construction financing. Okay. So does Adair Financial Services, do we have the ability to do 0 down construction loans?
Yes, we do, Jay. And what we do on this is we're loan to value, and I can explain what loan to value is, but I'll answer that question first and explain what loan to value is, Jay. So regardless if you're buying land or if you already own land, as long as the project appraisal yields a minimum 10%. So let's say you have your land, you have all your costs together, and it's $500,000. We want that to appraise at 550 or higher to give you at least 10% equity to get you to no down. So what that is basically loan to value based. So loan to value is just basically this, and it's easy to understand as I give this example. $500,000 project. Let's say somebody wants to put 20% down, Jay. We know 20% of 500,000 is 100, which would leave your loan amount at 400,000, right? That's your loan to value is 80% then, right? 80% of 500 is 400,000. So it's really just a simple math equation of taking the loan amount, dividing it into the appraised value, and then you get loan to value.
Got it. Okay, that makes perfect sense.
Yep.
And so let's take some time to go over each of the loan products that Adair Financial offers. Can you talk to each of the loan products at a high level?
Yeah. So we are a full service broker. We do existing loans as well, but 99% of what we do is to serve Adair and construction lending. So I'm going to talk about the construction programs really to answer your question, but understand everybody that I can do any type of permanent loan or existing structure as well. But for this conversation, construction lending, there's really 2 programs, Jay. There's what's called a 1 close and a 2 close. And there's a lot of different names for those, but those are the names we use. So a 1 close is just that, is you're closing upfront one time. And then I talked earlier about modifying into your permanent loan with that simple signature and paperwork. That's your 1 close. We're only doing 1 loan throughout the entire period. So that's a 1 close. And there are obviously some benefits to that, Jay. Your costs are going to be lower because it's typically only 1 close. You're locking your interest rate up front, right? And then as the house is completed, we're going to look at that. And if the market has improved, we could do a one-time free float down to the current market rate. So that there's some benefits there in a 1 close. Now, one thing on a 1 close that's prohibitive sometimes is most of those loans are 12-month loans. So once if you go past that, it can get very expensive with extensions and hedge costs on your locked rate. The second loan is a 2 close, Jay, and that's basically 2 loans. The first loan is used like a line of credit or a big credit card to finance the entire project, right? You're taking draws out, you're paying your interest, same thing. But by the time the home is completed, we need to take that loan out or refinance it into your permanent loan. That's your second loan or your second close. So the benefit of doing that is a few. One is you don't have a 12-month cap or time frame. We can take these things out to 2+ years if you need to. So jurisdictions that take a long time to get permits or building takes longer, 2 close would fit those best. And then at the end, you get to choose. I mean, if for our veterans, you could do a VA loan as your takeout loan. You can do 30-year fixed, 15-year fixed, ARMs, whatever, FHA, whatever you wanted to do on that takeout loan, you could do. So we could structure it there. One of the things that people Not typically, but some don't like is the uncertainty of your interest rate, Jay, because on a one close, we're locking that up front. And on a two close, we're floating the interest rate until we do the second loan, right? But it really works well for people, Jay, that need a longer time frame and are okay with taking that risk, thinking that maybe the market will get better in 9, 12, 15, 18 months. So those are really the difference between the two construction loan programs we offer. And we're good at explaining and looking at the jurisdiction you're in and seeing, okay, average build times are this, or average jurisdictional times are this. We're going to guide you to the right product that fits your jurisdiction.
Interesting. So if I hear you correctly, it sounds like, just, sitting down or having a conversation with a loan officer, that's really the best solution to understand, am I in a jurisdiction where, builds are somewhat simple and straightforward?
Right.
Okay, well then maybe I do want to do a one-time close. Or what if I'm in the greater Seattle metro area and, builds unfortunately tend to draw out due to jurisdictional timelines.
Yep.
Maybe AFS is going to set me up for a two-step close, right?
Sure.
So,
yep.
And Ryan, you already touched on this, but a lot of customers want to, look at VA financing, FHA loans, et cetera. So you already touched on it, but
yep.
It sounds like, can you explain with
Sure.
the two-step product, like how and why we have that flexibility?
Yeah, Jay. So currently right now, on our one close product, then I'll move into the two close. On the one close product, we can do FHA one close. Unfortunately, we can't do VA one close on the one close product, but we can do anything we want on the two close. So for a veteran, and I understand, I've worked with a lot of veterans, Jay, and if there's, they have benefits there that they want to use, and I completely respect that. Unfortunately, we can't do it on a one close, but on our two close with that VA customer, we could do a VA loan on the second close. And the beauty of that, one thing I didn't mention on the second close, Jay, especially in a market right now where home prices are appreciating, people need to understand too that during a year or a year and a half or 2 years, values are going to keep going up. So when we get to that second close and do that second appraisal, that's going to push the value up even higher, which is going to give you remember I talked about loan to value, a lower loan to value, which is going to offer you possibly no mortgage insurance, right? Better rates, lower monthly payments, just more flexibility. And it's interesting right now, Jay, because we're seeing, because values have skyrocketed over last year, we're seeing about a 30% equity position on our closed deals as we look at the final loan amount compared to the appraised value. And that's an averaged over buying land and owning land. But if I average that all together, it's about 30% equity. So if a customer goes into a two close, Jay, and gets the appraised value, there's no down payment. And then the second loan, it's going to be a higher appraised value, and it's just going to lower their costs even more. So a lot more flexibility with the two close when it comes to those things.
I love it.
Yeah.
One of the final questions we have, and I see we don't have a lot of questions from the group out there, is that what are the minimum qualifications for me to be able to engage Adair Financial Services and look at funding a construction loan?
Yeah, Jay. So typically we need a 680 minimum credit score, middle credit score. For FHA, I can take it down to a 660 credit score. But for our purposes, usually we want to see a 680. And I will tell you, the average Adair customer is pretty dang solid. They're averaging over a 740 credit score. In the qualifications, we need that credit score. Obviously, it's the same qualifications if you're buying existing. We want to see 2 years employment. We want to see W-2, commission, self-employed. All of those things will work. It's just a different way of calculating income. But you're going to apply. We're going to run the credit. And I said it's a soft pull. And then we're going to provide a pre-qual. And that basically just tells you exactly from the site work, from the home, the land, everything, what's the max you can qualify for. And then from our team, we're going to contact you and go over that budget with you to get a good idea of how we want to structure this. So my team spends a lot of time actually just answering a lot of questions when we send out that pre-qual, Jay, to really get the customer to understand, where all the money is going to.
Got it. And Ryan, that made me think of something else. I do have one more question for you, so my apologies. Can you help me understand I don't know if it's a wives' tale or a misnomer about if I get pre-approved for a loan, it could affect my credit score.
Right.
So how does AFS work as far as credit pulls, hard pulls? I've heard soft pulls.
Sure.
Can you kind of talk us through that?
Yeah. So the first part is, when you're having any hard inquiry, there is a chance that it will pull your score down a point or two. But if you're out shopping for a mortgage, you're given like a 30-day window of getting number of inquiries for mortgage related, and it's not going to pull that down. But for our purposes, Jay, and I mentioned soft pull, and that's basically we're doing a pre-qualification upfront. A pre-qualification is different than a pre-approval. A pre-qual is what the consumer tells us, right? And we're just running credit. We're putting in their numbers. That's a pre-qual. A pre-approval is the next step, and that's verification. So we're verifying your W-2s. We're verifying your pay stubs. We're verifying what you have in your bank. That's a pre-approval. So initially what we're going to do, Jay, is the first pre-qual, soft pull, no inquiry. That establishes the budget. Once the customer or the consumer gets to a point is engaging with Adair Homes and has land, we've done a site visit, everybody gives us thumbs up, we're good to go. At that point, we're going to contact you to do the hard credit pull. Because in order to underwrite a file through Fannie Mae is you have to have a hard credit pull. But we won't do that until we know for sure that you and Adair Homes are moving forward.
That's awesome.
Yep.
I love it. Well, I have to say, it looks like we've answered all the questions for today. If you still have questions, feel free to comment on this post, and we will answer them there. Also, you can interact with us on live chat. That's on our website. Give us a call or schedule a time to meet us. And any of that can be done at adairhomes.com/schedule. If you'd like to fill out an application or schedule a no obligation consultation with one of our team members at Adair Financial, please know that can be done at adairfinancial.com. So with that being said, Ryan, I want to thank you very much for your time today and for being with us. And thank you to all of our listeners. And we will see you next time on Adair Live.
Thanks, everyone.